think, act, and prosper. You are now tuned into the Money Level Show.
Hello, everyone. Welcome back to the show. Glad to have you all here with us at the Rule Symposium. And today, we're interviewing in person Hugh Agro. How you doing today?
Good to be with you, Daryl.
Yes.
Great day, great week to be at the Rule Symposium.
Yes. So Revival Gold, obviously, we've talked multiple times, and so looking forward to jumping more into the company. So I want to start with just a high level of, like, where do you think we're at in the market right now? I mean, some people, you had the euphoria at the beginning of the year. Gold, obviously, sold off quite a bit. It's still been hovering around $4,000 an ounce. Silver as well. Silver's sold off significantly, still about 50% off the highs. How are you kind of thinking about that? I mean, because people, obviously, they're investing into this sector because of the price of the commodity.
Yeah, it's volatile. That's the word, right? And changing every day by not just a little bit, but by a lot. The good news here, I think, though, is that the gold fundamentally is important in our economy, to the strategic well-being of these central banks that are buying up the gold. And we're seeing now that gold is the largest store in central banks, just surpassed the store of treasuries. So I think the long-term fundamentals are sound. And if we look back historically, the average rate of return on gold, the metal itself, has been pretty solid, but there is volatility. And I think that creates opportunities for investors, right? If you're astute, watching the stocks, watching the relative values of those stocks compared to the metal, there's some really good opportunity out there.
Yeah. So a lot of times folks are buying the metal, obviously as a way to preserve their purchasing power or to hedge against any type of risk. I mean, you got governments printing money galore across the world, right? And then you got central banks buying gold for a reason, right? There's a reason behind that. And we've talked at length about many of those reasons: Russia, Ukraine, and the seizing of their assets and things of that nature. And people want that sovereignty. So you have that aspect of it. And then you have this other layer where it's like you can invest in the companies that pull it out of the ground, which gives you more leverage, gives an investor more leverage to, make more money, make more dollars, or whatever the case may be. So with Revival Gold, how are you kind of like positioning Revival Gold to benefit from the commodity itself, gold?
Yeah, well, it's a great point. You invest in the producers and the developers of gold to get extra leverage, extra exposure to the metal upside. So if we think about the structure of the industry, gold trading at about $4,000 an ounce, the producers trading at about $500 an ounce in the ground, and the developers like Revival Gold in that sort of $20 to $50 per ounce in the ground range. So as those companies de-risk their assets in the development space and move them into production, we make these values higher, and the benefit of that is that you get better exposure to the metal. So, for example, at Revival Gold, we trade at about $25 US per ounce in the ground. We're not going to get all those ounces out of the ground, but they are going to be worth $4,000 an ounce when we get them out of the ground. And when you look at a company like Revival Gold, as we march up the path towards production, we're working towards producing gold at $4,000 an ounce that you can buy today at $25 an ounce in the ground. Or another way to look at this, every 1,000 shares of Revival Gold represents about 19 ounces of gold in the ground. So that's really good leverage and exposure, your point. And the way we think about this, is that no matter what happens, gold going to $4,000, gold going to $3,000, gold going to $6,000, our projects are going to make a lot of money because they have a lot of margins to them. It's about a $210 million capital to construct our Mercur Gold Project in Utah. It's about an all-in sustaining cost of about $1,400 an ounce to produce the gold. And if you think about the margins, that's better than the software industry, better than the banking industry, better than transportation industry, pipelines. It's a really solid sort of margin to those ounces of gold that we'll produce from our project in Utah.
Yeah, so you mentioned like, $25 an ounce in the ground and such. Obviously, you have like the strip ratios and how much tonnage of rock and the grade and all of these geological components whenever you're developing a mine and such. And so could you speak a little bit to that? Like what are kind of the geological components that give you more confidence and also should give more investors more confidence in Revival Gold?
Well, it starts with the fact that we've got a really strong engineering and development team that's done it before in the United States with projects exactly like this. And you and I are skipping over a lot of details here. Yeah. You reference a few of them: geological, engineering, technical. But those are very complex details, and these projects do not come without risk. There is risk associated with getting that $25 an ounce in the ground valuation up to $500 an ounce the ground valuation, and we're not going to get all of the ounces out of the ground. But the way we think about it is simpler is best. Open pit, heap leach are simple processes for getting the rock out of the ground and taking the gold out of that rock. And so keeping it simple gives me comfort that we're going to do something that can be successful for our investors. Yeah. Low capital, the fact that our capital cost of construction is about $210 million, not $500 million or $1 billion or more. It's a manageable sum of money. Being on a site where gold has been successfully produced before. Remember, this is a former Barrick gold mine. Mm-hmm. It was operated by Barrick in the 2000s, so we have a lot of technical data and information to be able to reuse and leverage. And we've got infrastructure, so we don't have to rebuild any of the infrastructure associated with getting power to the site, roads, water, those sorts of things. And that makes things simple. Yeah. And simple is best.
Yeah, definitely. And it saves, the company a lot more money. I mean, you mentioned like it could be $500,000, it could be $1 billion, right? If you had to build like those roads and infrastructures and things of that nature, I mean, that just keeps racking up and adding to the cost to put the mine into production. And so when you're looking at $210 million, like, some investors may, that's a lot of money, but it really isn't in this space, right? It depends on what stage you are at as a company and then what access to capital you have and such. So could you speak to us from that level? So obviously you're here at the Rule Symposium because investors like Rick Rule invest in the company, believes in the company, has done his due diligence to say that, hey, Revival Gold is a solid company. I mean, you got Jeff Phillips, you got some people in this sector that are like, very well known and very good at what they do in analyzing these companies, and they're invested in Revival Gold. And so obviously that gives some level of confidence, but could you speak to more of that financing of, $210 million to get the mine into production?
Yeah, we're blessed. We have some wonderful shareholders, including Rick Rule, and Jeff Phillips, very supportive and knowledgeable, and we can work from their knowledge base and understanding as well. But our institutional shareholder base and our corporate shareholder base in total amounts to about 60% of the company's investors. And management itself, including me, own about 9% of the business. So if there's a lot of ownership here. There's a lot of support from strong backed, institutions that can fund these projects through to construction. The trick for us, and we have a healthy cash balance of about $37 million right now, which will take us through to a construction decision. But the trick here is always goes back to the asset. We've got something that's simple, high margin, in a good geographic location, with strategic value. These are assets with large gold systems. And so that gives us a lot of comfort around the financing. And when it comes to those discussions, we'll work through a number of different banks, private capital providers, streamers, royalties, all of those sorts of things we'll look at in a process over the next 12 months. But the early indications are that we'll be able to do this project in a very efficient manner for our shareholders. That is, minimizing shareholder dilution, and we'll be in that position to start construction by early 2028.
Yeah, definitely. So could you speak to that, like even from the developer's kind of perspective? So like for me, like, disclaimer, I do own Revival Gold. I am a shareholder. What I've noticed that with the developers, multiple different companies, like sometimes investors have a hard time kind of waiting for, to get it to that production, because it could be like a 2-year wait.
Yeah,
it could be a 3-year wait.
it can be pretty daunting, right?
Yeah.
And it can take a lot of time. This is not an industry where we can expect things to flip a switch overnight. Mm-hmm. So it does take time, when we do have to have some patience. But I think what's beautiful about these projects that we've assembled at Revival Gold is that we're on these brownfield sites that can move much more quickly to mm-hmm. production. So instead of thinking about a decade of permitting, we're looking at less than 2 years to complete all of those steps. Mm-hmm. And that gives us a huge advantage here, even in an impatient market where people are looking for things to happen more quickly. The other thing I'd say about gold developers is, there's nothing more boring than having gold sitting in a vault. Yeah. With a gold developer, the gold is in the ground, it's being advanced and de-risked. So not only do you get the exposure to the metal price, but you get exposure to the de-risking that the management team is working away at and carrying these projects forward. And ultimately those margins we spoke about earlier, which rival some of the industry's best, in terms of the kind of profitability that comes mm-hmm. from successfully mining gold. So I think the wait is worth it, is really the summary.
Okay. So when thinking about like how many ounces, could you remind me how many ounces projected there's a Revival Gold project?
So our Mercur project in Utah will generate about 100,000 ounces a year of gold, about $300 million a year of free cash flow at mm-hmm. current gold prices, and all of that for a capital cost of about $210 million. So you can see that high return makes this a very financeable project. Now, there's risks associated with this, and I would have folks refer to our website, www.revival-gold.com, to understand those risks and see more information about our projects. But the upside is commensurate, and we're really excited about the future for this company and what we're delivering. And we're doing so at a time when, as you pointed out, we've got volatility in the market, so it's an opportune time to enter the stock. And I think and gold's future is proven from a history of performance in the long term. Mm-hmm.
So could you speak to the kind of like the timeline? So obviously, looking at construction early 2028, Revival Gold has other projects, Bear Track, Arnett and such. And so how much of these ounces are like more like, inferred, indicated, measured resources, and then versus like probable and proven reserves? So what's that kind of look like for the company?
Yeah, overall we have about 6 million ounces of gold in resource. Of that resource, we have about 3 million ounces that are in measured and indicated. So just over half the resource is in measured and indicated. So that higher confidence resource, and then within that we've got about 1 million ounces of proven and probable reserve. We're working now on our Mercur project and bringing more ounces into proven and probable reserve. That will come with the PFS and the engineering work around that. The target will be in total for the company between our two projects to get to something in the order of 2.5 million ounces of proven and probable reserves. And that will come with our PFS first quarter 2027.
Mm-hmm. And so obviously that's a lot of ounces, right? And then you're looking at 100,000 a year, so that gives like a good decent mine life for the company as well. And then as those other resources become reserves, I mean that could also extend the mine life, right?
Yeah, that's that option value we were talking about earlier. So not only do we have option value from the gold price going up, we have option value from more ounces going into the proven and probable reserve. And then thirdly, we have the option value of discovery of new ounces, because these are big gold systems. Remember, these are 18,000 acre property positions, these two land positions we have in the US. And there's a lot of gold yet to be discovered from them. As time goes on and we put more investment into drilling and exploration, we're going to find more gold. And so that's the third piece of the option value in owning a developer like Revival Gold.
Yeah. Well, Hugh, I appreciate having this conversation today. I mean, obviously, I'm learning more about the company, even just having these conversations with you. The audience, I hope you all are getting some value from this conversation, learning more about Revival Gold. And so obviously go check out revival-gold.com to get more information. This is not investment advice, but encourage you to do your own due diligence. And Hugh, appreciate you for coming on the show.
Thanks for having me.
Yes.